Hey everyone, this is Geeta. Today I want to make a case for index investing. I know it sounds technical, but honestly, it's one of the simplest ways to invest. And if you're feeling overwhelmed by stock tips, fund recommendations, and constant noise, turn all of that off and just listen to this. When you put together what's been happening around India, the trade deals with the EU, partnership across regions, reforms to ease doing business, and now a budget that clearly signals a focus on long term investment, a pattern starts to emerge. Now, the Union Budget 2026 is out, the headlines are everywhere, but rather than reacting to each announcement, I want us to pause and zoom out. Now, in this episode, we won't be predicting markets or decoding budget jargon. This episode is about understanding what these broader moves could mean for everyday investors over the long run. When I know I want to zoom out and talk about what this means for everyday investors like you and me, this is what I mean. In my classes, we always start with the macro picture because, in my opinion, if the soil is healthy, the harvest may vary year to year, but over time, things grow. And this year's budget gives us a very clear signal about the kind of soil the government is trying to prepare. At a broad level, the intent is clear. The government plans to significantly increase capital expenditure. We are talking about a large infrastructure push, not just at the central level, but also through additional grants to states that are linked to how much they spend on capital projects themselves. In simple terms, when the center spends and nudges states to spend alongside, it creates a multiplier effect across the economy. Why does this matter? Because capital expenditure is not just short term spending, it's about building assets that last decades. Roads, freight corridors, logistics networks, manufacturing ecosystems. When capex increases, the economy expands, jobs get created, supply chains improve, productivity goes up. And when that happens, a lot of companies, not just one or two, get swept up in that tide. This budget also clearly signals where the government sees the future heading. With the advent of AI and advanced technologies, allocations have been made towards high tech and strategic sectors. Electronics manufacturing is a great example. The focus is no longer just on assembling devices, but on making the components that go into them. Things like camera lenses, capacitors, printed circuit boards. That shift matters because deeper manufacturing creates more value, more skilled jobs, more domestic supply chains. Another interesting aspect of the budget is how it's trying to crowd in private investment. Large infrastructure projects often struggle in the early stages because the risks are very high and returns do take time. So the government is stepping in to absorb some of that early risk, making these projects more investable for private players. Tools like risk sharing mechanisms, easier access to corporate bond markets, and partial guarantees for the infrastructure loans are all aimed at the same thing, making it easier for private capital to participate in long term growth projects. We also saw announcements around major logistics upgrades, things like new freight corridors that connect mineral rich regions to industrial hubs and initiatives around rare earths and critical minerals across multiple states. These are not 1 year stories, these are multi decade bets. They are the invisible lines that support future growth, employment, exports, and competitiveness. Now, this brings us back to investing. When governments invest at this scale in infrastructure, manufacturing, and future ready sectors, it doesn't mean every company will win. Some will struggle, some will disappear, new ones will emerge, but over time, the economy adapts and value gets created across the system. We've seen this before. Post World War II, the US economy grew steadily even as individual companies came and went. Post Y2K, despite multiple crashes and crises, staying invested in the broader market often beat the most active strategies. And that's where index investing quietly shines. Index investing allows you to participate in the economic growth without needing to predict which specific company or project will benefit the most. You don't need to constantly intervene. You don't need to be right all the time. Today, this doesn't even mean only one broad index. There are banking indexes, IT indexes, healthcare indexes. So, if there is a sector you believe will benefit from long term structural trends, you can invest in the sector as a whole rather than picking individual stocks. Now, let's talk about volatility because all of this growth talk doesn't eliminate the short term noise. Markets will react to tweets, to headlines, press briefings. Prices will go up and down. But markets going up and down is not a flaw, it is the feature. Volatility allows systematic investors to average their investments over time. When markets fall, you buy more units. When markets rise, those units grow in value. And over long periods, disciplined investing often becomes your biggest compounder. This matters more if you're a busy professional, if you're juggling work, family, responsibilities, and trying to make sense of all the investing advice that's coming at you from all directions. And truth be told, most people don't have the time or the bandwidth or interest to track markets every day. So, if your goal is to make sure your long term savings, especially retirement savings, have a real chance of beating inflation without constant monitoring, index investing is worth considering. Before I close, one important clarification. I am not recommending any specific index here. This is not about products, it's about participation, being invested, being part of a growing economy, letting compounding do its job. Index investing is not flashy, it's not exciting dinner table conversation, but sometimes the simplest strategy is the one that works the longest. And if you're still unsure, it's worth listening to Warren Buffett, the Oracle of Omaha. When someone like that repeatedly talks about the power of index investing for most people, it's probably advice worth sitting with. I hope this episode helped you zoom out and breathe a little. You don't have to do everything, you just have to stay invested. Thank you for listening. I'll see you in the next one.